Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Smart Investment Strategies for Recession-Proofing Your Portfolio. When the economy takes a hit, it's natural to feel uncertain about your financial future. A recession, marked by a decline in economic activity over several months, often stirs fear among investors. But here's the upside. Downturns can present unique opportunities if you know where to look. By making informed decisions, you can not only protect your portfolio but also set the stage for long-term growth. Let's explore why investing during tough times can be smarter than sitting on the sidelines. Understanding economic recessions. Economic recessions can feel like an ominous cloud hanging over financial markets and personal budgets alike. But understanding what triggers these downturns and how they affect our worlds is the first step in finding smart ways to navigate them. Let's break this down into clear concepts that make sense for any investor. What defines a recession? A recession occurs when there's a consistent decline in economic activity, typically measured over 2 consecutive quarters. Economists often look at several data points to confirm a recession, with GDP, gross domestic product, playing a central role. When GDP contracts for 6 months or more, that's a strong signal. Beyond GDP, other key indicators include job losses, dips in consumer spending, reduced manufacturing output, and weakened corporate earnings. It's not just about one bad month, it's a broader slowdown that strains both businesses and households. The National Bureau of Economic Research, NBER, a trusted authority on economic cycles, may also officially declare a recession, though their assessments often come after the fact. Why does this matter? Because knowing how a recession is identified can help you recognize early warning signs and prepare your finances accordingly. Common causes of recessions. Recessions don't happen out of nowhere. They're usually triggered by specific events or patterns that ripple through the economy. Here are some of the most common causes. High interest rates. When central banks raise interest rates to curb inflation, borrowing costs for individuals and businesses increase. This can slow spending and investments, which then drags down economic growth. Bursting economic bubbles. Think of the housing bubble in 2008 or the dot-com bubble in 2001. When markets become overvalued and eventually collapse, it can lead to widespread financial losses and a recession. Reduced consumer confidence. When people fear for their jobs or future income, they spend less. Lower consumer spending shrinks demand for goods and services, hitting corporate revenues. External shocks. Unpredictable events, such as pandemics, natural disasters, or geopolitical crises, can disrupt supply chains, halt industries, and spark global uncertainty. COVID-19 is a textbook example that sent the world into a sudden economic downturn. Credit crunches. If banks tighten lending due to fears of economic instability, it becomes harder for businesses and individuals to get loans. Without access to credit, growth can grind to a halt. Knowing these triggers can help you see recession risks coming before they fully unfold. Economic impacts on industries and individuals. The ripple effects of a recession touch everyone, though not always in the same way. On a broad scale, entire industries may slow down, but the depth of the impact can depend on the sector. Industries hit hard. Discretionary goods and luxury services often take the first hit. People cut back on vacations, fine dining, and big-ticket purchases. Real estate and automotive sectors often see steep declines as borrowing becomes more expensive. Industries that hold steady. On the other hand, essential industries like healthcare, utilities, and grocery stores may not feel as much impact. Some even grow, as demand for essentials rarely slumps. For individuals, the effects of a recession can be deeply personal. Job losses. Layoffs often spike as companies trim their workforce to save money. Even if you keep your job, raises and bonuses may shrink or disappear altogether. Savings and investments. Market downturns lower the value of retirement accounts and other investments, which can leave some people hesitant to make financial moves. Cost of living. While inflation may slow during a recession, rising interest rates can drive up loan payments for mortgages, credit cards, and personal loans. This creates a squeeze on household budgets, leaving less room for non-essential spending. Understanding these impacts is critical to forming a resilient financial strategy. While recessions are tough, they're also temporary. With the right perspective, they can offer opportunities to reposition and thrive in the long run. Why invest during a recession? A recession often feels like the worst time to invest. Markets are volatile, economic headlines are grim, and fear can take over. But savvy investors know that downturns present opportunities that are hard to find in booming markets. By understanding the dynamics of a recession and taking strategic steps, you can position yourself for significant financial growth. Opportunities for growth amidst downturns. During a recession, fear tends to drive the markets down. This can create a landscape where high-quality assets are sold off at a discount. It's like finding your favorite designer brands at a clearance sale. Smart investors know this is the moment to act. Here's where the opportunity comes into play. Stocks of strong companies. Businesses with solid fundamentals and a proven history of weathering crises often see dips in share prices during a downturn. These are key opportunities to buy stocks at a bargain price and hold them as the market rebounds. Real estate value drops. Housing markets can slow down, reducing property prices. If you're financially stable, this might be a golden opportunity to invest in real estate for less. Dividend stocks and passive income. Many companies maintain their dividend payouts even during a recession. This creates a chance to lock in higher than usual yields on stocks purchased at lower prices. Remember, the most successful investors aren't chasing today's trends. They're looking for assets that can grow over time once the economy recovers. Historical evidence of recovery periods. History has shown us time and again that recessions, while painful, are temporary. Markets not only recover, they often thrive in the periods that follow. Let's look at a few examples. 2008 financial crisis. The S&P 500 dropped by over 50%, causing panic across the globe. But by 2013, it had doubled from its lowest point. Investors who stayed the course or bought into the market during the crash saw tremendous gains. Dot-com bubble, 2000, after the tech sector collapsed and dragged the market down, companies that adapted and showed consistent growth roared back in the years that followed. Tech giants like Amazon and Google emerged stronger than ever. COVID-19 recession, 2020, markets plummeted quickly when the pandemic began, but they rebounded just as fast. Recovery wasn't just about getting back to pre-crash levels. Several sectors flourished as they adapted to new consumer needs and lifestyles. These recoveries illustrate a key takeaway. While downturns are tough, they're also followed by periods of significant market growth. Investing during these moments may feel risky, but it can set you on the path to future rewards. The power of long-term investing. Recessions tend to make people laser-focused on the immediate future. But successful investors embrace the bigger picture. Long-term investing isn't just about patience, it's about resisting panic and letting time reduce the impact of market fluctuations. Why does long-term investing work so well? Compounding returns. When you invest and reinvest earnings over decades, your money benefits from exponential growth. Even small contributions can grow substantially with time. Market recovery and stability. While no one can predict exactly when or how recovery will happen, history tells us that markets bounce back. What feels like a loss today may be a gain in 5 or 10 years. Reduced timing risk. Trying to time the market by guessing when prices are at their lowest is nearly impossible. A better strategy is to consistently invest, even during a recession, and allow time to smooth out short-term losses. Think of investing like planting a tree. Recessions might feel like harsh winters, but they're also part of the natural cycle. Your investments, like a resilient oak, can keep growing as long as you nurture them with time and care. Investing during a recession isn't about chasing quick returns or trying to outsmart the market. It's about staying steady, recognizing opportunities, and focusing on the long-term rewards that come with time and discipline. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.